G'day again, and this is a Eureka interview, obviously not interactive this time, but didn't kind of have time to make it interactive, but I just wanted to introduce you to Jamie McGeachie. That's how you say it, McGeachie?
That's correct.
Jamie McGeachie, from Townsville, who has a business, well, two businesses really, one called Finance One and one called Investor Central. And in a way, it's a continuation of the interviews I've been doing on peer-to-peer lenders. Jamie's not a peer-to-peer lender, but something similar, and I just think you should hear his story, and you should look at this as a possible yield investment for you, particularly with all the turmoil going on in the markets. This is an alternative to investing in markets which go up and down, obviously, to get yields. So, g'day, Jamie. Thanks for coming in.
Pleasure, Alan.
Now, can you just tell us a bit about yourself to begin with? You come from Townsville.
Yes.
Originally, and what was your business in the early days?
We originally started lending money on a short-term basis about 18 years ago in 1997, and then the business evolved from there.
Right, so you're early 40s now?
Yeah, 43.
And so 18 years ago, you were pretty young.
Yes.
What did you start a pawnbroking business? Was that what it was?
Yeah, joined the family pawnbroking business.
Oh, see, so your parents had a pawnbroker?
Yes, that's correct.
Right, I see.
Yeah, so I went and joined that family business, and then from there, we're looking for scale. What we could do next. We started doing personal finance from there, and it's morphed into that. We're looking for business opportunities.
So what sort of, just tell us about the early days of that, just so we get an understanding of where you come from. Were you sort of broking finance in those days, or where was the money coming from for you to lend?
Yeah, it was all our own money, so we were self-funders. We were operating our own personal loan book. Not only were we doing and writing the loans, but we were collecting the loans. So how I got my industry experience was writing loan contracts on a daily basis and then going out there and obviously collecting the money.
So you had to go and collect the money on delinquent
Yes.
borrowers?
Yes, we did, yeah.
Right.
And used to do that 3 nights a week, and then every Saturday we'd pack the kids up, make them lunch boxes, and go out there and collect.
So you
our
took
loan
the kids
book.
with you to collect the loans?
Yeah, it was quite unique what we did. But it was great experience.
Did you have any trouble sometimes?
Never. We had a great process. It was very personable, and not once. I'm very, very proud.
Please
to say.
repay your loan.
Yeah, well, pretty much. It was about building a rapport. So the last thing we talked about when we called on them was the loan. It was always an engagement of the client. So we were concerned, why haven't you been able to is everything okay? And from there we were able to engage in a dialogue on where they're at that particular time. And that's been one of the secrets to our success now. We continue to do that today.
So when did you launch Finance One? So that was Finance One. That was your lending business.
It was a different brand back then, but it was a loan book that we operated, and it was called Your Finance Direct.
Right. And did you start selling the loans via brokers? As well? Is that how it worked?
What happened was we launched.
Or did you start becoming a broker yourself?
Yes, we did. Yeah, we launched a higher end personal finance centre from there, which was at a different location. We were also accredited to do mortgages, and we also got accredited to do vehicle finance. And some of the financiers were taking our applicants and looking after them, and then some of them were declined. And we'd go through those declined thinking, well, we're already operating our own loan book. This is a decent client. We know they're going to pay from our previous history, and we ended up putting them on our own loan book.
Right. And then so you launched Investor Central, which is how I kind of saw what you were doing and became interested in you.
Yeah.
The Investor Central thing. You launched that in 2010. Tell us about why you did that and how Investor Central is structured.
Alan, previously we were self-funding our loan books, and it just outgrew that. From us starting to write our own loans, we got inquiries from other brokers wanting to promote our product. It was a niche in the marketplace. We just couldn't fund it. So in 2010, we started Investor Central and Finance One as a clean skin, as an individual loan book. And Investor Central now is an unlisted public company that's the capital raising arm for Finance One.
Right. And how does it? What are the securities it issues?
Yeah. So we've got no other financiers other than our investors, and we issue a redeemable preference share. We operate under a full prospectus, and our investors are able to invest through that preference share offer in our company.
And so I've got a prospectus here. last year's prospectus, and the investment. Why don't you just tell us? I can see here, but why don't you just tell us what the interest rates are and the terms? How does the preference work?
Our investors have an opportunity to invest in our company from anywhere from a 1-year term through to a 5-year term. It's a fixed interest security that we offer from rates of 9% through to 16%.
So the 9% rate is for 12 months for a principal amount of $10,000 to $125,000.
That's correct.
Right.
We encourage our investors just to put a toe in the water. Transparency has been the key to our business model. Every 3 months our investors get a performance report. So it's a business update of a performance of our loan book, but also detailed financial reports on that too.
And the interest rate goes up to 16% for 500 to 1.5 million that's for a 60-month term.
Yes.
So 5-year term. So if you invest, that's basically a term deposit, 5 years, 500,000 minimum, 16%. What's your average interest that you pay?
15%.
Right.
Most of our investors will come in, they'll put a toe in the water, so to speak. So that toe in the water can be anywhere from $10,000 to $50,000, right through to some of our family offices now that are investing with us. They won't put anything in that's less than $1 million. An investor can have more than $1.5 million invested with us, but it's a multiple security. So we have different maturity dates. We're very prudent on our lending, so we borrow long and lend short.
Yeah, well, that's very interesting. You told me that before. And tell us, what's your average term on the borrowing, or at least the preference shares?
Yeah, 48 months.
Right, and what's the average term on your loans?
41 months.
Right, so your average term on the prefs is longer than the average term on the loans, which is opposite to what a bank does, because they 100% they borrow short and lend long. You do the opposite.
Yeah, we're very prudent about that. So we have self-imposed embargoes. We'll only have a maximum of 5% of our funds at the 12-month mark. Yeah.
Right. And so what's the average investor amount, the average size of the investment?
Just under $300,000.
Right. Okay, so average interest, 15%, average amount of 300 roughly, or close to that, and average term of what?
48 months.
48 months.
Yeah. Alan, our investors can start off and then they can add to that investment, or they can have separate investments too. So an investor might put $100,000 in to start with. They'll test the water, and then they may add to that in 6 to 12 months' time to go up another bracket then. That does reset the term of their investment. If they wanted to have multiple investments, then they can have different maturity dates as well.
Okay, so let's talk about security. The prefs presumably are unsecured, however, they rank ahead of other investors in Investor Central, is that right?
Our competitive advantage in the marketplace is that we don't have any other financiers other than our investors. So investors come along for a journey. So they rank before ordinary shareholders, and the ordinary shareholders is obviously just myself for preference to be paid.
Right, and so therefore we need to learn about your loans, obviously, because that's what is backing up the investments.
Yes.
Tell us about the loan book. How big is it?
$42 million.
And what's the average size of the loan?
Our average size of the loan is about $18,000.
Right. Over what period? You mentioned before it's 41 months. Yeah.
So we do vehicle finance. So it's only vehicles that
only vehicles
that we finance. We're looking for a client that needs. It's a critical purchase to their lives. So we're looking for a client that needs that vehicle to get to work as part of their journey, or to run the kids to school. And we're looking for a vehicle around that $15,000 to $20,000 mark is our average loan or average price point. So it's a decent quality second-hand vehicle that we do, and it's capped at $50,000.
So the maximum loan is 50.
Yeah.
Right.
Yeah. So we don't have any big ticket items. There's no $1 million loans or $500,000 loans. The maximum ticket item is $50,000.
And what's the interest rate on the loans?
Anywhere from 19% to 29%.
And what determines that difference?
Risk rate. So the profile of the client that comes to us, notwithstanding that, is that the purchaser, what they're purchasing, there's a plethora of reasons that go into that.
So how do you determine the credit risk? What's your process?
Yeah, we've been doing this for 18 years, and we've built our own internal processes to be able to distinguish between what risk grades are.
Do you want to tell us a bit more about that, how you go about it?
Yeah, stability of address, stability of income, Also, where they've had credit before, where they might have fallen down before, or they might have an even clean credit history. They just want to establish a credit history. That, along with the bank statements, on every client that we get 3 months worth of bank statements, a minimum of. Some clients we get 6 months worth of bank statements. It's like a window to somebody's financial soul. We really drill down into those bank statements to make sure that they are credit worthy to get the loan. So we're looking for what's their discretionary spend. You know, are they at the pub or at the pokies? You know, that's going to probably set them aside from somebody that is got stability around their employment.
And I presume you do get their credit score, but you don't rely entirely on that.
No,
obviously not.
No, it's one portion of what we do. A credit score for people, they can be excluded from credit for something as little as a unpaid telco bill, and that's going to sit on their credit history from anywhere from 5 to 7 years. There's a large industry sector which is estimated up to 4 million Australians that fall outside the mainstream lenders. They have a cookie cutter approach, so their business is mechanised. So ours isn't. We take the time to understand each client, and through that understanding, only 1 in 5 clients are actually approved for a loan. So 4 out of 5 are knocked back on average.
And where do you get all your leads from? Do you lend direct, or is it all through brokers?
All through brokers.
Right.
Yeah. So we've got 550 brokers across Australia now promoting Finance One.
Right. And what's your default rate?
Last financial year, it was 5.4% of our revenue, or 1.5% of the loan book. In the industry that we operate in, which it's quite low.
Yes, well, what's the average? How does it compare with
Some of our competitors,
the industry average?
Yeah, some of our competitors can be as high as 12 to 15%.
Of what?
Of revenue.
Of revenue,
Yeah,
right.
yeah.
And well, I mean, how should we think about it? Should we look at it in terms of percentage of revenue or percentage of the book? I tend to usually look at it as a percentage of the book.
Yeah, I'm the opposite. I look at the revenue, because without a cash flow, revenue is the most important thing. It's what you're banking on a monthly basis. So we use our snapshot of revenue. Yeah.
And so you obviously are getting some defaults, but only 1.5% of the book, or 5.5% of revenue.
Revenue, yeah.
What's your process for dealing with delinquent payers?
Every business is going to have defaults. After we've gone through our strict and prudent application process to identify the profile of a client that we want to do business with, because I've been lending and collecting money since for 18 years now, we have a dedicated customer service representative, and that collections team's all done internally, all in-house. The dedicated customer service representative will walk hand in hand, one of our employees, with our client through their journey to owning a motor vehicle. We really take the time to understand what the client's going through. So any time that they pick up the phone and talk to Finance One, they talk to the same person. We send them out birthday cards, we send them out scratchies, we send them out Christmas cards. So we really go on a journey with that client. And we will work with the client through that. So if somebody misses a payment, it's not the end of the world. Yes, we do try to make that up next month, or we can stagger that over a next 10-week period to make that up. Or even if they don't make that up, it only extends the term of their contract by another month anyway. So it's not the end of the world. Our main focus is to keep people making those regular repayments. And the business model works.
So yeah, I mean, when somebody actually defaults, what is included in your default list? What has actually occurred? What's happened?
Yeah, there's different terminology around default. If somebody misses a payment, then obviously we chase up that payment, we encourage that payment to be made up, and we get that made up over time. If somebody actually defaults, so they're in default on the loan,
At what point have you decided they're in default? Is it three repayments or what?
Yes, yeah. If they've missed three repayments and it's going in a cycle, then obviously we've got mercantile agents who will go into a field call, but they're scripted. We want that mercantile agent just to pass the phone over, so we've re-engaged that client.
I thought you said you didn't use mercantile agents, that it was all done in-house.
No, it is all done in-house, but we still need somebody to, if somebody's missing a payment, we still need somebody to go out there and do a field call.
Oh, I see, because they're not all in Townsville.
No, we can't fly around the country.
You got people in Perth and so on. Yeah, that's right. So you do send it out to a debt collector to go and see them.
Correct, but only to go and see that. We're still engaged in that process. And worst case scenario, we do have the security there, and we'll go and repossess that car and realise
So you
the asset.
so you go and get the car. So the defaults we're talking about have result in repossession
Yes.
of the car.
Yes.
And is the default amount of whatever, 1.5% of the book or whatever, and is that the difference between the resale value of the car and the loan?
Yes, that's correct.
That's what we're talking about.
Yeah. So it's a securitized loan.
Yep, that's right.
And the investors are secure by way of the loan book, and they rank before ordinary shareholders, which is myself.
So do you have sufficient loan demand to get away pretty well anything that's invested in Investor Central?
We've grown over time. The capital raising document that we currently operate under, which is a full prospectus through ASIC, is a rolling 12 months. So we raise capital on a monthly basis. Because we're in control of that, if we go through a growth cycle, we can ask our investors that there is room or an opportunity to invest with us. Vice versa, if we plateau that, then we don't need that investment. So obviously we're not going to take a huge trenches of cash and be sitting on money that we're paying 15% for. So it's a very smart business model. Some of our investors that understand the model want me to go and keep growing the business because they want to put more money in.
Well,
so the whips are out there.
But I imagine you do want to keep growing the business, right?
Very much so, yeah. We've got just over 3,000 clients currently active on the book. Our goal is to get that to 40,000 clients.
What we're talking about is borrowers, right?
Yes.
3,000 borrowers, just over 3,000. So you want to go to 40,000. So are you going to do that by expanding your broker network?
Yes, that's correct.
Right.
Yeah. And we've also got the peer-to-peer market is also a market that we're actively engaged into as well.
What do you mean? How are you doing that?
Well, the peer-to-peer market is, there's a certain segment that they can look after, and there's also leftover clients that they're unable to service to. So we hope to be able to be engaged in that market as well.
Right. What about early redemption by investors? Is there a process for that?
Certainly. We keep 7.5% of the loan book set aside for capital adequacy for early redemptions or unforeseen circumstances. So we're quite strict in that regard. It is a fixed term investment, so whilst we don't have a run on the investment, it is at the board's discretion. Obviously, if it's a compassionate ground.
So when you say you can't have a run,
correct.
Is that what you mean?
Yeah. We take a view that we need to protect the investors as a collective. So we've got 135 investors where we need to protect all of those. So if somebody passes away and they need their money out, then we're going to take a compassionate view for exiting them early. But it protects the investors as a whole. So we have those strict guidelines in there.
And how much cash do you keep on hand?
As at 30th of June, it was just over $6 million.
Right.
So we've got cash for growth, and also our capital adequacy is ticked off.
And so would you normally keep that sort of cash on hand?
Yes. Yep. We don't have any financiers. I can't stress that enough. Our competitive advantage in the marketplace is that we've been able to have our investor base. So we need to keep that cash.
So how much of your 42 million book is actually financed by preference shares?
We've got there's $8.9 million of unsecured notes left over, and the rest of that is all preference shares. When we started under an information memorandum.
Of unsecured notes,
yes,
right,
correct.
I see.
And they've indicated that they're rolling over, which is May and June next year, to the preference shares.
And do you have any intention to bring in institutional investors?
It's an option in the future, as long as it doesn't have an adverse effect on our existing investor base. They've been our supporters from day one. We want to go on a journey with them. We've got a 20-year plan. We're coming up to 6 years into that, and they're the mainstay of our business model.
Well, it's been good talking to you, Jamie. Thanks for coming in.
Delighted. Thank you, Alan. Appreciate it.
So I'm sure they agree. That was very interesting. And go onto their website. It's called Investor Central and also Finance One. But Investor Central is where you'll find the prospectus and all the other documents there if you want to have a look at it. So thanks again to Jamie.
My pleasure.